Hey guys, Freaky Finance here. A couple weeks ago, we did IPO'd, and this week we're going to continue on the China theme with Miniso. Last couple weeks were super busy, so I'm trying to get back into the grind of things. Anyway, this is, actually, I think it's the first time we've done the franchise model on the channel, interesting enough, which is surprising, given there's already more than 100 videos on this thing. But, anyway, so Miniso is a retail storefront. It does have some e-commerce sales, but it's largely franchise model business. They sell quite a few different things, so fragrances, plush toys, beauty and skincare, home essentials, electronics, hair accessories, bags and accessories, stationery, and gifts. There show some pictures with some random stuff, so you get an idea what types of things you'd see in this store. In terms of its revenue, it's still largely in People's Republic of China, the PRC, though lately it's been expanding relatively aggressively into America and other countries. You can kind of see that here. To make the numbers a little bit more, not confusing, but just more disaggregated, they did change the year end recently, so I'm more excited to see what June 2024 looks like. But you can see there is a relatively high growth rate here, especially in places outside of China. What I'm trying to do is wait for the 20Fs to show up, and then I can go through the 20F. The most recent one. So MNSO actually came up just recently this week. So that's why I'm doing this one this week. I don't actually own this one anymore. I did write it up a bit. Here you can see what they claim their success is dynamic product development, an efficient supply chain, and a deep operational know-how backed by digitalization. And lately, a lot of the growth has just been through store count, specifically overseas store count. But you can see their store network expansion as China is also increasing. The stores in China increased from 2,939 to 3,226 to over 3,600 now. And at December 31st, they had 3,900 stores. So still growing in China, but they have been recently pushing this globalization strategy push, which we'll see when we go through the numbers, because we're going to see margin expand. And this is a large reason why. So not only is revenue growth doing quite well, especially overseas, but the margins are expanding at the same time because of this overseas push. Basically, the end sales price is higher overseas, so the margins are improving. And that's despite more of the sales mix coming from third-party IP. And we'll talk about that as well in a second. But just kind of level sets where I'm going with this and why I'm excited about it. And why it screens well, even though if you look backwards looking, you might be like, well, the P is pretty high for something on this channel. It's because I'm forward-looking, going a couple of, maybe even 2 years out. It's actually not that expensive, especially for the growth rate. And you can see the percent of revenue coming from overseas went from 20%, 26%, 33%, 36%, still around 36%, the most recent cutoff point. And importantly, we're also seeing the revenue per store slowly increase, going from 1.9 to finally 2 million. But they claim they have product value propositions, so they generate revenues from sales of high quality and affordable lifestyle. Really, in my mind, it's cheap, but it's not like made cheap, so it's just a good value for what you're buying. It's probably what their value proposition is. They try to identify market trends and collaborate closely with designers to develop and roll out products with balanced appeal, quality, and price. And they co-brand with IP licensors with popular brands. In terms of their supply chain, it's largely in China. A lot of the stuff is made in China. Let's talk about the actual franchise model, which is probably the more interesting part of this business. Here you can see they refer to them as MNSO retail partners. That refers to their franchisee model, where the franchisee bears the store opening capital expenditure, the store operating expenses. The MNSO retail partner model includes that company, so the company that we'd be buying, retains ownership of the inventory in the franchisee's store before it gets sold to customers. And they also provide store management and consultation services to the franchisee for a fee. And then the franchisee keeps the remaining portion of the in-store sales proceeds after remitting a portion back to us. In terms of revenue recognition, again, they've issued a series of agreements with certain retail partners, primarily in China, Indonesia, and Vietnam. Revenue from sales from these partners is recognized at the point when they obtain the legal title of the products and become obliged to pay for the products, which is when the retail partners sell the products to their customers at their own retail stores. So basically when it's sold at the franchisee level. They're basically treating that the retail partners are customers for them, which is interesting, but again, they're not realizing the revenue until the actual product's sold to the end user. Again, the retail partners employ and manage their own staff and operate their stores and serve their customers. and bear the costs associated with the operation. The retail partners carry a wide range of merch, and they exercise their own discretion to select from their array of product categories. So each kind of franchisee picks what they want in their store. The retail partners are responsible for the placement, the custody, and condition of the merchandise, and MNSO, the parent, doesn't have any obligation to practice or accept any return of unsold products, except in rare cases. They kind of push the onus, like whatever the franchisee orders from MNSO, they're kind of, I would say, obliged to sell it. Can't just bring it back to the parent after the fact. Here's probably an interesting paragraph as well. The retail partners have the right to price their merch within a specific range that's recommended by the parent company. They also have the ability to carry out discretional promotion campaigns, and they can decide whether they want to participate in them or not. Partners can offer discounts on selected items beyond the range specified, but will have to bear a substantial portion of reduced margin from lowering the sales price on such campaigns, aka the franchisees eat a lower margin if they want to push the price to move the product, or lower the price to move the product rather. So that's on the franchisee side. So it kind of puts more pressure on the franchisee instead of the parent company, Miniso. So these are things to keep in mind. This could be a good thing from the parent. It can be a bad thing. This reads like a good thing. It puts quite a bit of risk on the franchisee. But again, at the end of the day, you need the franchisees to make money to make this relationship work. But there is always a friction that I want to bring up here between the parent and the franchisee. You need to make sure they're both aligned. And at certain times, this relationship can be frustrated. We kind of already talked about this, but inventories are finished goods which are held for sale, including the products that are placed at the franchisee store. So the things that you see in inventory on the balance sheet, while they're in a franchisee store, they're still the companies still saying they own them until they're sold. And when they're sold to the end user, that's when they book the revenue and kick it out of inventory. So this is probably gives a better idea of more of the products and the intellectual IP part of the business. So you can see their branding with things like, you can see Disney products here at the top. You got Toy Story, Hello Kitty, Sesame Street, Spider-Man. You can see what they're doing here, right? Pikachu. So basically, we kind of saw this with Funko and Build-A-Bear and Jack Specific, kind of with the toys theme. Again, here's the same thing. Just basically get the third-party IP, kick back a royalty percent to the IP, and you get the sale because you have the hot product. Now part of their thing is to try to guess which things are hot and design them with the third-party IP in mind. And a part of this also helps because they actually have very low cost because they're made in China or sourced from China. Could be made somewhere else and brought in through China, but still has cheaper labor. But anyway, I digress. In terms of the split, like where things actually sold, you can see 52% of the revenue is from sales to franchisees. So it's very important to the business model. That's why I wanted to bring it up and take some time on that part. They do have some sales to offline distributors. We didn't really talk about that, 22% of the business. And they do have some online sales as well. They do have some retail sales in self-operated stores, but it's only 8.9% of the business. So it's largely a franchisee and sales to offline distributors. I did want to kind of see what's kind of required to actually become a franchisee, and you would need to invest about, this is on the, I think it's .ca or .com, so Canadian or American. But anyway, you can see that it costs between $250,000 to $500,000 and requires a net worth of $1 million to be a franchisee. Well, maybe we'll go through the numbers real quick, and then you can kind of see what I'm seeing with the gross margin. But here, since I have the page open, you can see that the gross margin has been just improving over time, going from 26% to 30% to 38%, the most recent quarters, 42%. So we've seen margin expansion, and we're about to go through why. So when I look through the last 3 years, this doesn't include the most recent information. It's actually been accelerating since then. But you can see fairly strong revenue growth. And we're talking 11%, 13% overall. It's recently accelerated from this growth rate. The cool thing with this company, instead of just a double-digit revenue growth, is the margins have gone basically in line. So revenue is up 2.4 billion renminbi, but GMV is also up about 2 billion, right? So it's had material sales growth while at the same time having margin expansion is what I'm trying to say here. Now we have seen some selling and distributions increase, and a part of that is from more IP. So you might be able to get a higher sales price for the branded product, the hot brand. Think like a Marvel or Star Wars or whatever, or Disney. or Pikachu, whatever you want, higher margin as it reports, but again, you have to kick back some royalties to whoever the brand is. We're seeing that in selling distribution costs. However, one of the cool things is that despite material revenue growth, we've actually seen G&A expense come in very well. So they cut costs well during 2023 into something while they were still growing. And so basically the business just looks like it's improved materially in terms of profitability year over year is what I'm trying to say. We have seen some recent appreciation. I did this I want to say a week ago. The share price was a bit higher than it is today, but you can see it's still cheaper than when it originally IPO'd, but it's no longer dirt cheap as it was back in 2022. Though we have seen a superior performance since then. The balance sheet actually has very low in terms of traditional debt, and actually has a decent amount of cash on hand. They actually raised this when they did the IPO, so the cash on hand came from, as well as the current free cash flow that they were generating. They recently started issuing dividends, which is basically the free cash flow is going down. So it builds up, and they pay a dividend and goes down. That's kind of what the trend's been so far anyway. It's a relatively new company, so we'll have to see how they actually do. But so far they've started to improve the shareholder remuneration. Again, we've seen this kind of trend in China lately where we've seen companies either increase the buybacks or increase the dividends to try to get people to buy their companies because no one currently is. Right? We've just seen 3 years of outflows in China with everyone still afraid. Anyway, you can see the free cash flow double in 2 years. Anyway, you can see the G&A scale relatively well over time. It looks like that trend's going to continue, but we'll see. And then you have the profit margin improving, obviously, with higher growth margin, scaling its cost base with into a decent revenue growth number. We're seeing margin expansion on the bottom line. So it has it's actually a pretty decent grower, especially coming out of China during this last couple of years where it's been relatively weak. Now, a lot of that growth is because their international has been pushing so hard. So we're seeing a lot more in terms of international year-over-year growth. And it does have a lot of room to run. I mean by that is just when you look at how low America and other Asian countries, excluding China, are, they're not even like a seventh of what China currently is. And Europe's not even on the board, right? It's a tenth of America. So they're still very underpenetrated in a lot of countries. And if they can replicate what they're doing in China, which in my mind is probably the more competitive place to make money, just because so many other places you're competing with there also have low cost to make things, right? Whereas I just think your advantage, and I think that's also what's showing up the numbers lately, is they're able to push their advantages that they learned in China by competing into the rest of the world, right? Not only are they low cost, but they're able to outcompete whatever there currently is in China. Or at least that's how I read this. All right, so we talked about the margin increasing. This is their reason why. They're basically saying a higher gross margin was mainly driven by overseas markets contributing more, as well as higher revenue contribution from directly operated markets. We're seeing higher gross margin in China, which contributed by newly launched products, so freshness, as well as strategic brand upgrade of Miniso. And we've also seen cost-saving measures we've adopted to reduce the cost of certain products. And they also say that their sales mix, they get a higher gross margin of top toy. There's a lot of things here that are improving the margin over time, which is showing up in the numbers. This one is interesting. So in terms of the one of the reasons why G&A scaled so well, here they flagged G&A was decreased due to personal related expenses in relation to cost control measures of our corporate crew, and decreased depreciation amortization due to capitalization and depreciation line of use. So for the headquarters. So one that's just accounting noise, one that's actually from through cost control. So they've been able to grow while cutting back costs. And you can see kind of where they're trying to go here. Let's focus on more IP because we're seeing that improve the margin profile. That's your third-party design. They do have a pretty aggressive revenue CAGR of 20% growth, and they want their IP products to be more than 50% of their sales by 2028. And they're still opening about 1,000 new stores each year for the next 4 years. So it is a pretty high growth story. And we're also seeing margin expand at the time of this growth because they're pushing into higher margin areas with higher margin products. I just like this setup. It screens very well in my head, and I think I have an understanding of it. I kind of talked about the sales trends already, but here's just another way to see where you're growing the most in. You're growing most in toy brand, 90% year over year, which is higher margin. You're growing more in overseas operations, which is directly operated markets, more year over year. And while you are growing in domestic e-commerce, it's only at 6%. So your China offline actually started growing again recently year over year, but not so much Q over Q. More mixed on the China side, but it's still pretty high numbers. And then you can see the overseas operations are just putting up numbers across the board, which is why the margin is scaling up. And you can see that here in the gross margin point, going from 40 to 41 to 43 again on this sheet, with the profitability profile improving from 15 to 17 lately. So those are more recent numbers, again, just showing the continued trend and improvement. We have seen the market finally realize that a bit, but again, the company is far better than it was when it IPO'd, and it has an easier trend to what I can see as improved profitability in the future. And it's still trading relatively cheap to what, not on backwards looking earnings, but on what it's currently putting up and what it's likely to do in the future if you believe in this strategy here. Gufo still owns quite a bit of the stock from the founder of the company. And there's a couple of funds in there that own a decent amount of their portfolio size, but not too many. I'd say it's relatively underfollowed. Canada Pension Plan has the biggest in terms of market value. That's only 0.3% of their portfolio. But anyway, you can see that in my mind it's still barely underfollowed. It still has a key founder that owns it, which is important to me. If I want to own something in China, I'd rather have someone with me to hold the pain. This is a picture of them right there. For what it's worth, Forbes described this business as a retail chain known for value of goods money, such as $1.5 mascara and $6 headphones. They have expanded quite a bit, just like if you were to look at your current city, wherever you are in North America, most of you guys are in North America, you'd be able to see kind of quite a bit of stores actually in different places. I just picked California here, but you could go anywhere and just kind of see where they're over-indexed to or where they still have a lot more exposure to happen. Right, but you can see they're kind of focused on more dense areas, like this is Houston. Anyway, I was trying to dig for things. I always try to find things I don't like, and this is one that was interesting. Trade receivables still small on the balance sheet, but this thing caught my eye because I was like, here it says group has significant exposure to individual customers. Remember, the customers they call their franchisees. And in the last 3 cutoff periods, 40% of the trade, 53, 40, and 40. So it's gone down, but still 40% of the total trade receivables were due from the group's 5 largest debtors, respectively. And they say trade receivables derive mainly from sale of goods to distributors and franchisees. So it does mean that there's some bigger franchisees here that could have some type of pull with the parent company. So it's not just like your mom and pop franchise. It could be a certain individual or another company even that has a lot of Miniso franchisees, right? And so that could be an issue. In order to look at that, you'd have to keep track of this, which is just the age payables or the age trade receivables for the company. It's like AR, but for franchisee. And you can kind of see basically what they do. Here's the more current reason. They're still a year old, but you can see that the current, they just write off 2%, assume they won't collect 2% of it. 90 days, they assume they won't collect 10% of it, so quite high. But then once they get to, I'm surprised they even have this category, they mark off the whole thing after 810 days past due. And that is it's a small part. You can see the dude collect most of it within before 90 days hits, right? But it's a decent amount that they're writing off, and it is important to watch this if we see trades receivable build, or we see this start getting bigger and bigger. Obviously, it's going to slowly get bigger anyway because revenue growth is there. But just make sure that it's not building in here, because it could imply that someone has some type of power. One of the franchisees, right, or 2 of the franchisees might have a decent amount of power and pull against the parent company, MNSO. So something to think about, but currently it's not an issue, but it could be an issue. So I want to make sure that I bring that up. I thought it was interesting. That was on page 107 of the 20F. But yeah, other than that, it's an interesting company. But yeah, basically, the crux of the matter is the revenue growth there, and they're growing in the places that have higher margin. And a lot of the risk is pushed onto the franchisee. It's an interesting company. It's hard to find something that's growing as steadily as this company has, even during the challenging time that China has. It's continued to grow well. And yeah, I'd like to know your thoughts on Miniso, and have a great rest of your weekend.